All right. Happy Friday, everybody. I'm super excited to see everybody here. Hey, Gemma, Ira. Oh, there's Danielle. Hey, guys. I love seeing so many friendly names that I recognize to join us each week. But hey, in case we have not met before, my name is Melissa Langdale, and I'm the president and COO of the Mortgage Collaborative. And we're super excited that you guys are joining us today. And I am joined this week by two brilliant professionals, Jodi Hall, who is the CEO and founder of Road Consulting, and Michael Jones, who is the Director of Mortgage Lending at UFCU. Welcome, Jodi and Michael.
Thank you for having us.
Thank you.
Absolutely. Well, while we get folks in, I like to have a little bit of fun for those of you that know. We do a little bit of trivia on Friday morning or Friday afternoons I don't even know what time it is apparently. But as we get folks in, and so since Michael, you're new to the credit union space, I thought it would be super fun for us to do some credit union trivia. Are you ready for this?
Ready.
Awesome. Okay. And this is for everybody. So if you know it, and put it in the chat for us. What is the oldest, what is the first when was the first credit union established? I'll be clear.
So I'm taking all these. You're not helping, Jodi?
You can guess.
Good luck.
I'm gonna go with, let's see, credit union. I'm gonna go with 1930.
1930. Okay. Jodi, what do you think?
I was going to say the same as the 1883. Isn't that a TV show?
I think that was a big banking crisis in New York.
We got a bunch in the chat. Oh my gosh, everything from like 1883, 1932, 1860, 1930s. All right. The actual answer is 1864, but it was in rural southern Germany. So it was not in the United States.
Okay.
Gemma got it right. She Googled.
Yeah, Gemma's
one to get it right.
Someone
Someone has ChatGPT going on.
Yeah, AI for the win. She totally said it was ChatGPT. Which state was the first U.S. credit union opened? So which state did the first had the first U.S. credit union open in it?
Yeah, I want to say New York, but I'm gonna go with Pennsylvania.
Pennsylvania.
I'll say Virginia.
Virginia.
Sorry, I had a dog chewing on an electric cord.
Wrong. There's a few in the chat that have it. It's New Hampshire.
Oh.
There you go. Learn something new every day. And then this one, because we do have some residents of this state on the call, this should be super easy. Which state actually has the most credit unions?
Texas.
Texas. That's right. All right.
It's like, that was pretty daring, Melissa, doing that with two IMBers for life, with not knowing anything about credit union space until recently.
Well, Michael's learning and you're learning, and I thought it would be super fun to have some fun credit union trivia while we get started. All right, well, I'm going to go ahead and get us kicked off. For those of you that have watched the last couple of weeks, just so everybody is aware, we talked about wanting to change up our format a little bit. Each one of our shows now is going to have actually a different perspective on it. And so this week we have, Jodi representing the consulting space and Michael representing our credit union space. And then we're actually going to take these different perspectives and solve real problems or real questions that lenders have. And we're going to have some fun along the way. For those of you that haven't seen, I put all of these real questions that I'm either emailed or that live in our Ask TMC platform, if you're our TMC member, into my handy dandy fishbowl, and we fish them out of the fishbowl together and work to solve them. A couple of changes with our new format. One, because we have changed up the format a little bit, we actually are going to change the name of our show to from the rundown to the fix. So every Friday afternoon, you guys are going to get your TMC fix, and we'll have some fun fishing out some real questions from lenders and solving real challenges that our lenders are having. And the other kind of new thing that you'll see about our program is, as y'all know, this program has had our friend Rob Chrisman join for the last, forever years. And we're super grateful that he's been a part of our world. But Rob he did not want me to announce this while he was on, but he has just recently decided to spend his Friday afternoons with his precious granddaughter, Cosette. And so we're super excited he gets that time and space to spend with her. You may still see him on occasion, but we're not going to see him every single week. So, all right, we're going to go ahead and get started with our fishbowl. Michael, Jodi, are you ready?
Maybe.
All right, should we do a big question or a little question?
Doesn't matter.
Doesn't matter.
Go big. Let's go
Let's
big.
go big. Okay, let's go big. All right. Here's the big one. Let's see.
That just means a big piece of paper, like it could be
It really
a little
is just
question
a
and
big piece of paper. It's
Okay,
a small question, but a big piece of paper. All right. What technology solutions are you most excited about right now? Any that are driving some real results in your process or your customer experience? Jodi and Michael, this seems right up your wheelhouse.
Jodi, I'll let you take it.
I'd say we've been working together on some of it. I think the most exciting technology is those technology companies that are willing to work together to push more of the manufacturing process to the front of the process. And Michael and I have been working together at UFCU to do just that with some of the partners of TMC. Michael can share if he wishes to, who they are. He might want to keep them a secret for a little bit longer till we get some stuff across the finish line. But we are really taking the approach through CRM and point of sale, trying to push verifications into the point of sale, using AI underwriting to condition and underwrite the documents as they're coming into the system up front, so that we can have a more robust pre-approval process before the loan ever hits the LOS. And we feel as though that the project that we're working on includes importing of fees and settlement service provider list, automated verification of employment, not having to pay an exorbitant amount of money for that, automating the conditions, so it's the real underwriting conditions, not just the generic needs list, and also the underwrite of income specifically in the front end of that process. And that way the individuals are spending more time, but we're calling the entire project sales enablement technology. But we really believe that it will enhance the member for the credit union, or what we typically call the borrower experience, but it also should enhance the loan officer experience and be able to drive more. We know if we can automate the outreach to the members, that we're going to get more business, and then we just have to work backwards in that process. Mike?
Yeah, I mean, second what you said, probably to add a little piece to that. So one of the things that I am most excited about as we end 24 and head into 25, regardless of what the interest rate environment does, is, and I'm going to keep the name quiet for now. I like that, a little bit of mystery, Jodi. But there's a technology that we have. We have over 380,000 members as part of the credit union, and we really have a huge opportunity in front of us to show them that they can get their mortgage through the mortgage division, and a vast number of them have not historically. And so This new technology will allow us to reach out to them, identify those opportunities, and tee it up for our loan officers to help them with a refinance or even a purchase. We know we're not going to help all of those members every single year, but if we can get just 5, 7, 10% penetration on that, it is a really significant number. So I'm excited about that. It's always nice to have the tools to be efficient and to get things done more quickly and cheaply, but it's also really exciting to be able to tell your loan officers, hey, we've got this technology that's going to give you 3, 4, 5 more leads per month, maybe even more, so that they can go convert that business. That's a great retention tool. It's a great recruiting tool. So I'm excited about that for the next year.
I love it. I love it. I love when technology works together. Sometimes it solves for these like siloed, right, problems. And it sounds like you guys are really looking for a holistic solution where you're pulling together some providers to really create an interesting customer experience and a sales tool as well. So that's great. All right, I'm going back. Oh, you're
The only
muted.
other one I will say, if you may have seen the post this morning, but with Candor underwriting FHA loans, that was a big holdup for a lot of lenders in the past because of their ability to work on conventional loans. And now with having a lot more FHA loans in the process, because borrowers' qualifications, higher debt to income ratios, it was a huge feat to be able to pull it off, but actually have the Candor underwrite on the FHA product as well is super exciting for the industry, and excited about working through what that means for with underwriters who historically it's like not my chum's number.
Awesome. All right, I'm going back. You want to go big or small? Does it matter?
Switch it up, go small.
Okay, I'm going small. Here we go. This one's really small. Ooh, this is a question from me. I throw some fun questions in there because it's just fun for me. What was your hardest risk you've ever taken in your career? I know. I know.
Where do you want me to start? I've taken quite a few.
Just pick one.
Probably the biggest jump was the most recent one, and that is going from full-time president, COO, Nationwide Mortgage Bankers to independent consultant. And I think that that's larger also because of I've talked about this before, that as you get older, you lose your confidence. I usually frame it in the reference of a horse. Like you get more and more afraid to fall off of the horse as you get older. But being at this point, being at my age and that point in my career, I think was the biggest risk. And I still get that imposter syndrome sometimes, like what were you thinking? Because not only are you constantly working to make sure that you are keeping your clients happy, but you're also having to prospect because you have much shorter contracts and you don't have that 4-year contract of that I had in my previous employment.
I love it.
Yeah.
All right, Michael, you want to share?
What was the question again, Melissa? I think I remember, but
big
say it
risk.
again.
Big career risk.
I mean, I'm probably going to have to say the same with Jodi. We owned Thrive Mortgage, and just a hard decision all around, and it's hard to know always what the secondary impacts of that is. This is arguably the toughest environment that the mortgage industry has faced, may ever face. I mean, that's a bold claim, but it's just been so weird the last couple of years, and I'm not sure that the federal government will repeat what it's done ever again, because now they can see the outcome of their actions. So that's probably it. So yeah, and now we're here.
All right, I'm going for another question.
Okay.
We'll do an easier one, maybe. Oh gosh, this is a really long question. Does anyone have guidance in place to address excessive Freddie LP runs? It sounds like a couple months back, they had an external QC vendor that cited 2 loans as having excessive numbers of runs, which were really 7 and 6. without having an LOXY, each was run. They were asked for a specific reference. Oh, they asked for a specific reference to the guidelines so they could address it and got basically a best practice comment. And so Freddie has no requirement or guideline for this, but their internal QC team really wants to establish a number. Have you guys established a number? Have you seen anything on that?
I mean, in my experience, anything less than 25 is okay. At that point, they can see that you are kind of gaming the system. Word on the street is that there's an enhancement coming from the GSEs that will help prevent this. It sounds like you're aware of that, Melissa, but that there is something coming to address this that will make all of our loan officers, LOAs, underwriters, everybody a lot more efficient. So I think the short answer is Freddie specifically is coming out with a solution to address that.
Yeah, Freddie totally is.
And I don't know how you don't have double-digit runs when you're trying to qualify borrowers in this environment. I mean, I'm the same as Mike. I would love to have the conversation with the individual that asked me for a letter of explanation. I can tell you that. I would be curious to know how many were in the front end of the process, because I feel like before application, when you're trying to structure the loan and to get it to work, because of higher debt to income ratios, I can see that would be that I would like to see the statistics on it. I bet we have a higher percentage of runs in a higher rate environment just by allowing the loan officers to run it and almost use it as a qualification tool and a scenario tool to be able to work towards the approved eligible. But I have never heard of that requirement or stipulation being put on. And my guess is that the firm that was hired, they didn't know that there were 2Gs in mortgage.
The 7 and 6 is small. I mean, I especially for a purchase, it's, that beginning part of the process, to your point, I was a little shocked by this one too.
You put borrowers on, you take borrowers off, you you
we got
have
some
to
big chat going on about that.
Assets like that seems like minimal.
Yeah. We have a question in the chat, which is not in the fishbowl, but I'm gonna address it for Robert, because I know the two of you can tackle it. But how do you accomplish housing affordability without taming regulatory cost increases?
I don't think you do.
Yeah. Go ahead, Michael. You look like you're pondering.
I guess I'm going to take that to mean regulatory, maybe like building and kind of zoning and local type things. Yeah, I don't know that you do. I saw a graph the other day that showed just that the number of administrator positions has just hockey sticked in the last decade or two. And so, we don't necessarily have more individuals, whether it's students or houses or citizens or whatever. It's just, we've hockey sticked it for any number of reasons. Probably the only answer I can give as to how do you accomplish housing affordability, you do it with unique products. Manufactured housing is probably our low-hanging fruit, and yet most of America, maybe realtors, really turn their noses to that. So I think that the easiest, quickest way to do it is just with different products than what we have now that can help sort of circumvent that. But even at the local level, it's no trick for these city councils to make it impossible to actually get communities established so that you can have these types of houses anyway. So yeah, I don't know that you can.
We talked about it on Spark Lab this week. For those of you that don't know what that is, this is TMC's kind of innovation focused, show. And there are a couple of local municipalities and nonprofits that are actually coming together between the realtors, the Mortgage Bankers Association, to try to solve for inventory issues in their markets. And so there are some kind of unique solutions coming out. But it's not an easy answer, and it's not just necessarily inventory. I think in the mortgage side of things, there's a cost of compliance in our space too. When you think about all the technology solutions that you need to meet not only kind of Fannie Freddie guidelines, but also your federal regulatory requirements and your state level requirements too. There's just all the layers that are in our space. all the disclosures, all of the, process checks and balances throughout, the verification checks and balances throughout, the cost of verifications going up, the cost of credit going up, right? All those extra layers are adding to the challenges, and I think also are impacting affordability for especially that first-time home buyer too. So
Yeah, even in our local community in Nowhere, Ohio, are several counties that are coming together, and local banks are opening up financing for 3D printed communities.
yeah,
So it's really exciting to see that taking place and see where it grows. But that goes back to, you're still going to have a lot of compliance fees. Like, can you get, like, working through the local communities, can you get permits? Can you get financing? Do we have enough historic data on 3D printed homes to be able to make communities comfortable to allow them to be built in their area? So we are in a very difficult situation with the lack of housing in the United States.
I agree. Yeah, we spent some time talking about like comparables too, right? If you build that community, at least it's going to be comparable to one another, but it doesn't fit the Fannie Freddie box, right? So then what does that do to like the pool of homes that can be used for comparables in other areas too? So I think there's like bigger, broader questions of like short-term impacts on how do we get immediate housing supply, right? And then longer term impacts to how do these homes sell in the future and how do they hold up in comparison to some of the others that we have to address. So, all right, I'm going back to the bowl. Are you ready?
Yep.
Oh, okay. This one's kind of cool. It kind of plays into what we were just talking about. What does the next generation of homeowner look like? What do you think their biggest barriers are to becoming a homeowner?
I mean,
The want to move out of their parents' home.
well, it's funny you say that, Jody, because I was actually going to offer, like, I almost see that next gen housing that I think Lennar or somebody came up with being sort of the next big thing. Because you look at how many millennials there are, there's tons of millennials, and you look at how many boomers are, there's tons of boomers, and the boomers have all the equity. They have all the equity in the homes, they have all the assets, and you have this, I think this desire, like I'm seeing more and more people in my generation, millennials, that are living closer to their parents. And a lot of times it's the parents moving from wherever they are because they want to be involved in their grandkids' lives. Either they're still working and can do it remote, or they have the assets, partially because they can sell their home for a ton of money to be able to go and relocate. And so I wouldn't be at all surprised if that becomes a little bit more of the norm of this multi-generational living, because, those grandparents want to be so involved in their grandparents' lives, and the proximity of having a smaller section of your home that's kind of closed off and sort of a second unit can be very attractive from a cost standpoint, safety standpoint. As your parents are aging in place, they can age right next door to you, but they're not in your house, they're next to your house, or they're kind of like in a little bit of an attached ADU to your house. So to me, I mean, that makes a lot of sense. Not everybody will see it that way, but you just look at those two massive generations. I think between the two of them, there's like 140 million people, which is, roughly a third or a little bit less than a third of the total population of the United States. So that's a big deal. So, I mean, that's kind of what I see. It is interesting that a bunch of millennials don't want to have kids. Because there's a lot of us, we're not following in the same footsteps of the boomers that, they're typically having 2 to 3 kids. There's whole, millennial family husbands and wives that don't want to have kids, and so we're going to see some interesting demographics from that. Who knows? But to me, it's murky out there. But those are still going to be the two most powerful segments in real estate.
Yeah, and Robert did put ADUs in there, which I would also say kind of along Michael's answer. I also saw recently Costco is building condos on top of the retail stores. And I think that the younger generation has this need to feel community and be close to people. So, and if they never had to drive a car, I mean, I can't believe how late in life people are getting their driver's license. When I was a kid, I couldn't wait. Like the day I turned 16, I went to get my driver's license, and now you see that being stretched out. So I think that the more that we can build communities around where you can get health care, you can get groceries, you can get everything that you need in a small community and have housing around that. I think that will definitely, we're seeing a little bit of it in some areas in and around Cleveland, where the younger generation, they want to live close to each other.
Yep. Yeah. Paul says driving is stressful. Younger generations suffer from high anxiety. I think the mortgage industry suffers from high anxiety right now. All right.
Yeah, I was on my way home yesterday from the airport, and I almost hit chickens. They were out in the middle of the road. So it's very scary. Very
That
scary.
driving stuff, man, is dangerous. Okay, this one's super easy, but it is a personal question, but it is super easy. Who is your favorite teacher growing up, or your favorite class? If you don't remember the teacher's name, favorite class.
Do you know, Mike?
Yeah, I guess, I'm a little bit less removed from school. The there was one teacher. So at Georgetown High School, there was a teacher, Mr. Fisher, and he taught, I think it was world history, or it was some history. But he kind of taught more like a college professor, where it wasn't, it was a lot more like, I'm going to tell anecdote and story and kind of not just have this lesson plan that I'm reading off to you. And, you had some of that Socratic method of teaching where he would ask questions and, really want the class to participate. He taught that. And he also taught a psychology class at, high school senior level that I thought was really interesting. But I think it is because he didn't follow that traditional teaching method. And he really did want to hear what the students thought. So he would open it up for discussion and try to get students to disagree with each other. And I thought that was kind of interesting. So
Very cool. Jodi, how about you?
So my 81-year-old aunt has taught in the same school system for over 60 years. And she tells me all the time I was her favorite teacher. And I was like, I didn't even get the opportunity to be in your class because you kicked me out like almost every day in junior high math. But definitely is very influential in a lot of students' lives. And then on the higher level at John Carroll University, my economics teacher was Dr. Navratil, and I just like loved his approach. Of course, love economics, and really enjoyed that. But I'll have to say my aunt Kay Housley first, Mrs. Housley, and because she's still going strong. I'm not sure where Dr. Navratil is today.
That's fantastic. Mine was anything math. I loved it. It was like a language to me. It was really cool. I loved it. All right. Last one. I'm going for a big one. It's just a little scary. Oh, do you have experience with Fannie Mae delayed financing? One of our lenders was looking for a connection with somebody who's really good at running DU. They're trying to run one and doesn't think that DU is seeing the correct info, resulting in an approved and eligible. So yeah.
Defer to the audience.
Yeah.
that's right.
We may have to phone a friend on that one.
Yeah, I mean, I will say, happy Kevin, I think, is on the call here, and not to add to his workload, but he tends to be one of our go-to folks at UFCU. So we are at UFCU always happy to help the TMC membership tackle those types of questions. So if they want to reach out on that, but I do think Rich posted here, and I know that may be one of the questions in the fishbowl that might be worth ending on, just to kind of talk about some innovations around the workflow.
Yeah, I like it. Rich says you won't receive delayed financing findings. It will just be a generic message on cash out refinances. So there you go. We got an answer. Thanks, Rich. But Rich's question in the chat is, what do you feel is the ideal workflow for qualifying a borrower as far as requesting the minimal amount of paperwork, electronic uploads, LOXs, et cetera, to minimize cost and risk? Is it to run all applications by more of an underwriter processor before asking the borrower for additional information after they complete an application? It's a good question.
Yeah, I think that leads back to kind of our conversation. It is with the 1003 data, you can leave the property as TBD. You have, you run soft credit so that you don't create trigger leads, which we might be able to get around in the not too distant future. There's conversation around that. We won't go there today. And then and then running AUS to be able to see what the real conditions will be on the loan. And I think that if you want to, the least friction for the consumer is if you go and get either asset validation through one of the automated services or get income validation through one of the services so that you can calculate income. Because remember, you can calculate income on the on your conventional off of the asset deposits in some scenarios, and it's less expensive. Or you use one of the alternative verification of income and employment solutions that has a lower cost than our friends that is exuberant, because your income typically is going to be what is going to disqualify you. I think it's fine that the consumer, I mean, people are going to tell you what they have in their accounts unless they're coached not to from an asset perspective. So I think minimally being able to get enough information to calculate what the income is going to be, running credit and AUS, and I think that that's the least intrusive of the process, and you can have a pretty good idea of whether that borrower is going to be, what amount they're going to be able to qualify for.
So I'll offer two thoughts on this, and they're a little bit similar, but I think distinct enough. So I'll go for the less radical one and then the next one. So I do think the way that we do mortgage today as an industry is kind of silly, because we have a decision maker so far removed from the front end of things that we waste days and steps and money and all these types of things simply because it has to look a certain way for an underwriter in order to touch it. Or, we need to make sure we touch these boxes so that one of our highest paid assets doesn't touch something that doesn't make sense. And I get that. But I do think that I think Movement kind of did this a few years ago, but it was a little bit smoke and mirrors. So sorry to offend Movement people if they're on here. But, I think getting an underwriter earlier in the process is better. And so if we were to tell that borrower, hey, fill out Flowify or Simple Nexus, fill out your online application and do it honestly and as correctly as you possibly can. We've made this as easy as possible for you, and it won't take that long, but give us the best information because we want to pass that directly to an underwriter. There's no reason for an LO, an LOA, and a processor to all agonize over calculating this income. Just send it back to an underwriter, because an underwriter should be able to say, okay, oh, you're a teacher. I know what your income's going to be. It's pretty simple. You've told me right here. This is what it's going to be. All I need is a pay stub to back up what you've told me. And so we can condition these files in such a way that all of the brain power has been done. Then we have somebody that is paid less to be able to go, all right, the brain power told me I needed X, I have X, and it matches. I'm done. And you can do that a lot quicker. So I would advocate that we move the underwriting piece much earlier in the process and basically allow a direct submission to an underwriter. Then we have the LOA and processor clean it up. And then the underwriter is doing a last look right at the end to make sure that all those critical pieces have been touched. The second version of that, which is a little bit more extreme and may not be possible in reality, is for the LO to do everything that they're doing today. They're getting all the docs today, and they are basically creating an appointment with an underwriter and say, hey, the underwriter is going to look at your file at 9 a.m. And it's going to happen. There's going to be no disruptions. Like, they're going to show up at 9 to look at your file. They're going to call everybody at 11 or 11:30 and say, hey, I've conditionally approved your file. They are actually talking to the borrower. Hey, borrower, I just need X, Y, and Z. And if you can get that to me by the end of the day or tomorrow, like, I'll clear to close your file. We're done. And you're taking out all the steps, all of the miscommunication, all of the loan officer sitting on the conditions and not sending it out to the borrower for 4 days. And you're handling it right then. And the borrower feels very good because they've spoken to a decision maker. They can problem solve if they need to, and everybody goes on their way. So it's kind of similar, but I do think that bringing the underwriter in sooner and taking away that whole, like, the underwriter sits on a pedestal and they can't be bothered, and, where there's this back and forth pushing of information is just silly. And it's one of the reasons why we've got the cost to originate a file the highest it's ever been. So I'll step off of my, my pulpit here, but I feel like we need to do
because it's
that.
getting feisty in the chat. I love
It
it.
is getting feisty in the chat. This was super
Hi,
fun.
guys.
We are over time though, and I want to be really respectful of everybody's time. Michael, we're going to end on the feisty note,
Okay.
but I really appreciate you sharing your insights with us. Jodi and Michael, thank you so much for your time, and thanks for everybody in the chat. This was really awesome, and we'll see you back again here next week. Have a good afternoon, everybody.
Bye, everyone. Thank you.